Hi, I'm Jonathan Bays, and this is our January investment market update. We ended the year actually in pretty good form across investment markets. The Australian share market closed up 11.5% on the year, and that was driven in large part by a real kick in global economic growth. The US economy is as strong as it's been since the tech boom in the early 2000s, and that growth is now spilling over into the rest of the world. Australia has been a little bit slow to the party in terms of an uptick. We've got a huge amount of household debt, which we've talked about on many an occasion, but we're now starting to see a bit of an uptick coming through in business confidence, and that's translating through to forward capital expenditure orders, which have really started to pick up in the second half of the year. So we hit 2018 with a slightly more optimistic viewpoint than we did a year ago. Some of the reasons for optimism on top of the improving economy stems from the shift that's now taking place globally from what has been a very heavy stimulus on the monetary side to increasingly now some fiscal stimulus, and we saw that over the Christmas period with the Republicans putting through a $1.5 trillion tax cut. And we're now likely to see, we think, other countries across the globe follow suit as a means to compete with the increased tax efficiency of the United States. So we're probably likely to see the federal Liberal government start pushing themselves as the side of politics pushing for tax cuts, and again, I think investment markets will take that well.
So with the current supportive economic backdrop, we do expect that our investments will continue to give a decent return. However, we're saying that market valuations are high, and we want investors to be vigilant. And in light of this, we recommend that investors increase their active approach to managing their portfolios to ensure that clients are managing risks effectively. Given our positive outlook on the economy, both domestically and internationally, we're looking to add cyclical exposure to our portfolios.
We've endeavoured to up our cyclicality amongst recommended portfolios. We've been long of seek for the last 4 or 5 months, and that's been really good for us, up about 20% since we put in portfolios. In the last couple of weeks, we've added Downer Group, which is an engineering services company in Australia, which also upgraded its earnings numbers in November, but we think it's got more to go. We've been adding Cube, which we think is a wonderful infrastructure play, and again should see the benefit of an improved local economy flowing through its port assets. And we've also added APN Outdoor, which is the premier billboard advertising company in Australia.
So for 2018, we will continue to watch the central bank withdrawing the stimulus. We do expect bond yields to rise on the back of this. With regards to that, we do expect volatility to also rise, especially in the second half of the year. And the other thing that we're watching for is US tax reforms. We expect to see some possible spillover in terms of other countries also reducing their tax rates. And also we are continuing to monitor the actual effects of the US tax changes, as it could potentially boost the US economy further.
So a really good start to the year, we think, in 2018, but things might get a little trickier as we hit Australian winter. But for the interim, we think some positives coming through on the economy. We think that the share market will push higher.